Why the Fed's one-cut call is a game-changer for your portfolio. Good morning, I am Eric from Market Meridian Finance Channel. If you're an investor in 2026, stop what you're doing right now, because the Federal Reserve just dropped a bombshell that will change your portfolio forever. For months, the market priced in 3, even 4 rate cuts this year, but Powell and the Fed just crushed those expectations. One cut. Only one 25 basis point cut in 2026. This isn't a minor tweak, it's a hawkish pivot that flips the script on everything you thought you knew about investing in 2026. At Market Meridian, we don't just report the news, we break down exactly what it means for your 401k, your ETFs, your real estate, and your cash. By the end of this video, you'll know exactly how to reposition your portfolio to survive and thrive in this higher for longer rate environment. Let's dive in, no fluff, just actionable insights first. Let's make sure we're all on the same page. For the past 6 months, the market was riding high on the idea that the Fed would pivot to a dovish stance in 2026, cutting rates multiple times to ease financial conditions, boost stocks, and support economic growth. Traders were betting on lower borrowing costs, investors were piling into rate-sensitive assets, and everyone was counting on a soft landing with easy money. But Wednesday's FOMC meeting changed everything. The Fed held rates steady at 3.50% to 3.75%, and their updated dot plot showed just one 25 BP cut this year, far fewer than the 3 cuts the market had priced in. This isn't just a miss on expectations, it's a clear signal that the Fed is serious about fighting inflation, even if it means keeping rates higher for longer. And for your portfolio, this isn't just bad news for some assets, it's a complete game changer. Let's start with the basics. Why did the Fed do this, and what does it mean for the overall market? Understand why this one-cut call is a game changer. You first need to understand the Fed's mindset right now. This isn't a random decision, this is a deliberate hawkish shift, driven by 2 key factors, sticky inflation and economic resilience. Let's break it down with hard data, not speculation, because at Market Meridian, we deal in facts. First, inflation is not cooling as fast as the Fed wants. Core PCE, the Fed's preferred inflation gauge, is still hovering around 2.8%, well above their 2% target. Powell even admitted in the press conference that progress on inflation has stalled, and warned of upside risks from energy prices and wage growth. Second, the U.S. economy is holding up better than expected. Unemployment is still low at 4.4%, consumer spending remains steady, and the labor market is more resilient than many predicted. Put simply, the Fed doesn't need to cut rates multiple times to prop up the economy, and they won't, because their number one priority is getting inflation back to 2%. This means we're not going back to the era of cheap money anytime soon. The higher for longer narrative that we've been warning about at Market Meridian. It's no longer a prediction, it's a reality. And this reality will hit every single asset in your portfolio, from your 401k to your rental property. Let's break down each asset class, one by one, starting with the most important one for most Americans, your 401. If you have a 401k, this Fed pivot is not something you can ignore. For years, 401k investors have benefited from a low-rate environment, where stocks soared, bonds provided steady income, and even conservative portfolios saw solid gains. But with only one rate cut in 2026, that playbook is out the window. Let's start with the bad news. Your 401k's stock allocation is likely to face more volatility, and your bond allocation could underperform if you're not careful. But here's the good news. At Market Meridian, we're not here to scare you, we're here to give you actionable steps to protect and grow your 401k in this new environment. First, Let's talk about your stock allocation. In a higher for longer rate environment, not all stocks are created equal. Growth stocks, especially those that rely on cheap borrowing to fund expansion, will struggle. Why? Because higher rates increase their cost of capital, which eats into profits and reduces their future cash flow value. Think tech stocks that aren't yet profitable, or speculative growth companies. You'll want to trim those positions in your 401k and shift toward value stocks, companies with strong cash flow, low debt, and high dividend yields. These stocks are more resilient in higher rate environments because they don't need to borrow heavily, and their dividends provide a buffer against market volatility. Next, your bond allocation. If you're holding long-term bonds in your 401k, you're in trouble. Long-term bonds are highly sensitive to interest rates. When rates stay high, their prices drop. Instead, shift your bond allocation to short-term and intermediate-term bonds, or bond ETFs that focus on high-quality corporate bonds. These are less sensitive to rate changes and still provide steady income. Finally, don't sleep on your 401k's cash or money market options. In a higher for longer rate environment, cash is no longer trash, it's a viable asset class. Money market funds and high-yield savings accounts linked to your 401k are now offering yields of 4% or more, which is better than many bond funds right now. So, to recap your 401k strategy, trim growth stocks, add value stocks and high-dividend stocks, shift bonds to short intermediate term, and increase cash positions for stability and yield. This isn't a radical overhaul, it's a strategic tweak that will protect your 401k from the Fed's hawkish pivot. ETFs are the backbone of many investors' portfolios, and the Fed's one-cut call will separate the winning ETFs from the losers in 2026. Let's cut to the chase. The ETFs that thrived in a dovish environment will struggle now, and the ETFs that were overlooked will become your new best friends. Let's start with the ETFs you should avoid, or at least trim. First, long-duration bond ETFs, like TLT, are a no-go. As we mentioned earlier, long-term bonds get crushed when rates stay high. Second, growth ETFs, like QQQ, which is heavy on tech growth stocks, will face headwinds. Higher rates make their future earnings less valuable, so expect more volatility and underperformance. Third, real estate ETFs. We'll dive into real estate in detail next, but for now, know that ETFs like FREL, Fidelity MSCI Real Estate Index ETF, have already started to decline, down 1.1% on March 18 alone, as higher rates push mortgage costs up and weigh on property values. Now, let's talk about the ETFs you should add to your portfolio. These are the ones that will thrive in a higher for longer rate environment. First, value ETFs. Look for ETFs that track value indices, like VTV, Vanguard Value ETF, or SCHV, Schwab US Value ETF. These ETFs hold companies with strong cash flow, low debt, and high dividends, exactly the type of stocks that perform well when rates are high. Second, short-term bond ETFs, like BSV, Vanguard Short-Term Bond ETF, or SPSB, SPDR Portfolio Short-Term Corporate Bond ETF. These ETFs have lower interest rate risk and still offer solid yields, perfect for balancing your portfolio. Third, ETFs that focus on sectors that benefit from higher rates. One standout is EQRR, ProShares Equities for Rising Rates ETF, which has gained 6.77% over the past 3 months and 0.36% on March 18 alone, as it's designed to outperform when rates rise. This ETF holds stocks in sectors like financials, which benefit from higher net interest margins. Fourth, high-dividend ETFs, like HDV, iShares Core High Dividend ETF, or VIG, Vanguard Dividend Appreciation ETF. Dividends provide a steady income stream, which is crucial in a volatile market, and these ETFs hold companies that have a history of increasing their dividends, even in tough economic environments. Finally, avoid leveraged ETFs unless you're a seasoned trader. Leveraged ETFs amplify gains, but they also amplify losses, and in a volatile market driven by Fed policy shifts, they're far too risky for most investors. At Market Meridian, we recommend a balanced ETF portfolio, 40% value ETFs, 25% short-term bond ETFs, 20% high-dividend ETFs, 10% rate-sensitive sector ETFs, like EQRR, and 5% cash ETFs for flexibility. This allocation will help you weather the volatility and capitalize on the opportunities from the Fed's hawkish pivot. Real estate is one of the most rate-sensitive asset classes, and the Fed's one-cut call is a gut punch for anyone invested in property, whether it's your primary home, a rental property, or real estate ETFs. Let's be clear, higher for longer rates mean higher mortgage rates, which means lower demand for homes, slower price growth, and tighter margins for real estate investors. Let's start with residential real estate. If you're looking to buy a home in 2026, you're going to face higher mortgage rates. We're talking 7% or higher for 30-year fixed mortgages. This will cool down the housing market, as fewer buyers can afford the monthly payments. For existing homeowners, this means your home's value is unlikely to skyrocket like it did in the low-rate era, but it also means you're less likely to face a crash, since the economy is still resilient. If you have a variable-rate mortgage, now is the time to refinance to a fixed rate before rates go even higher. For rental property investors, the math is changing. Higher mortgage rates mean higher monthly expenses, so you'll need to either raise rents, which could lead to higher vacancy rates, or accept lower cash flow. Focus on rental properties in high-demand areas, like cities with strong job markets, where you can still command higher rents without losing tenants. Avoid speculative rental markets where prices are already inflated and demand is weak. Now, let's talk about commercial real estate. This is where the pain will be most acute. Office buildings, retail spaces, and industrial properties are all sensitive to higher rates. Many commercial real estate owners have floating rate debt, which means their borrowing costs are rising sharply. This could lead to more defaults and distressed sales in the commercial real estate market in 2026. If you're invested in commercial real estate ETFs or REITs, now is the time to trim those positions, especially office REITs. As we saw earlier, FREL, a leading real estate ETF, is already down 1.1% on March 18th, and the trend is likely to continue as rates stay high. So, what's the silver lining for real estate investors? Look for niche areas that are less sensitive to rates, like affordable housing, senior housing, or industrial properties that serve e-commerce. These sectors have strong demand regardless of interest rates, and they're more resilient in a higher-for-longer environment. At Market Meridian, we're not saying to sell all your real estate, but we are saying to be selective, avoid high-leverage properties, and focus on cash flow over appreciation. Right now. For years, investors have been told that cash is trash, but the Fed's one-cut call changes that. In a higher-for-longer rate environment, cash is no longer just a placeholder, it's a strategic asset that can provide stability, yield, and flexibility. Let's start with cash, high-yield savings accounts, money market funds, and short-term CDS are now offering yields of 4% to 5%, that's higher than the yield on many 10-year Treasury bonds, and it's completely risk-free, up to FDIC limits. This means you can hold cash and earn a decent return without exposing yourself to market volatility. For investors who are nervous about the market, this is a game changer. You no longer have to take on unnecessary risk to earn a return. But cash shouldn't be your entire portfolio. You still need bonds for diversification. The key is to choose the right bonds. As we mentioned earlier, long-term bonds are a bad bet. Stick to short-term and intermediate-term bonds. Short-term bonds, 1 to 3 years, have lower interest rate risk, and their yields are now higher than they've been in years. Intermediate-term bonds, 3 to 10 years, offer a balance of yield and stability. They're less volatile than long-term bonds but offer higher yields than short-term bonds. You can also consider Treasury inflation-protected securities, TIPS, which are designed to protect your purchasing power from inflation, critical in an environment where inflation is still sticky. Avoid high-yield, junk bonds. These bonds have higher yields, but they also have higher default risk, especially if the economy slows down. In a higher-for-longer rate environment, companies with high debt levels will struggle to make their interest payments, so junk bonds are too risky for most investors. Let's recap the cash and bond strategy. Hold 10 to 15% of your portfolio in high-yield cash accounts, money market funds for stability and yield. Allocate 20 to 25% to short-term and intermediate-term bonds, or bond ETFs, for diversification. Avoid long-term bonds and junk bonds. This combination will help you balance risk and return in a hawkish Fed environment. Let's wrap this up with a clear breakdown of the sector winners and losers, and a step-by-step portfolio adjustment list that you can implement today. First, the winners, sectors that benefit from higher rates and a resilient economy. Number 1, financials. Banks, insurance companies, and brokerage firms benefit from higher net interest margins. When rates are high, they can charge more for loans while paying less for deposits. Number 2, energy. Higher rates often coincide with strong economic demand, which boosts energy prices. Look for oil and gas companies with strong cash flow. Number 3, value stocks. As we mentioned earlier, value stocks with low debt and high dividends are more resilient in higher rate environments. Now, the losers, sectors that struggle with higher rates. Number 1, growth stocks, especially unprofitable tech stocks that rely on cheap borrowing. Number 2, real estate, residential and commercial, as higher mortgage rates and borrowing costs weigh on demand and prices. Number 3, long-term bonds, their prices drop as rates stay high. Now, your step-by-step portfolio adjustment list. Print this out, save it, and implement it this week. 1. Trim growth stocks and speculative assets, especially unprofitable tech, from your portfolio. 2. Add value stocks and high-dividend stocks, or value ETFs like VTV, high-dividend ETFs like HDV. 3. Shift your bond allocation to short-term and intermediate-term bonds ETFs. Avoid long-term bonds and junk bonds. 4. Increase cash positions to 10 to 15%, high-yield savings, money market funds. 5. Trim real estate holdings, especially commercial real estate and real estate ETFs like FREL, and focus on niche, high-demand residential rental properties. If you're a real estate investor. 6. Avoid leveraged products and speculative assets. Stick to high-quality, cash flow positive investments. This list isn't rocket science, but it's critical. The Fed's one-cut call is a game changer, and if you don't adjust your portfolio, you could be leaving money on the table, or worse, losing it. At Market Meridian, we're all about helping you make smart, informed investment decisions, and this adjustment is one of the most important you'll make in 2026. Before we go, let's make sure you get the most out of this video. We've put together a free cheat sheet that summarizes everything we covered today. your 401k strategy, the best ETFs to buy, the assets to avoid, and a step-by-step portfolio adjustment guide. The link is in the pinned comment below. Click it now to download it for free. And if you have questions, like how do I adjust my specific 401k allocation, or which short-term bond ETF is best for me, leave a comment below, and we'll answer them in our next video. Now, a quick disclaimer, this video is for educational purposes only, not financial advice. Past performance does not guarantee future results. Every investor's situation is different, so always consult a financial advisor before making major investment decisions. At Market Meridian, we're here to give you the insights and tools you need to succeed, but the final decision is yours. Remember, the Fed's one-cut call is a game changer, but it's not a death sentence for your portfolio. With the right adjustments, you can protect your wealth and even grow it in this higher for longer rate environment. If you found this video helpful, hit the like button, subscribe to Market Meridian, and turn on notifications so you never miss our latest market analysis and portfolio strategies. Thanks for watching, and we'll see you in the next video.